Amazon.com's AMZN board of directors approved a 20-for-1 stock split on March 9. In addition to announcing the split's approval, the company also said that the board had approved a new share repurchase plan to buy back up to $10 billion of AMZN stock. In February 2016, Amazon put a $5 billion share repurchase plan into place. However, under former CEO and founder Jeff Bezos, the company never bought any stock. Fast forward to March 2022 under new CEO Andy Jassy. It's already repurchased $2.12 billion of its stock. While share repurchases and dividends are one way to keep shareholders happy, Amazon has never been a company that focused on shareholder returns, opting to allocate capital when and where needed to continue to feed its growth plans. It's one reason it never paid dividends. They're like a noose around the necks of growth companies. There are two ways to look at this latest announcement. The first is that Amazon will continue to grow in much the same way Apple, APPL, has with share repurchases, barely making a dent in its free cash flow generation. The second is that it becomes another company more focused on the shareholder than the customer. Jeff Bezos would tell you that's a losing proposition. There are arguments to be made on both sides of the issue. Here's a look at a couple of them. When share repurchases become routine. There are companies of all sizes that make quarterly share repurchases like clockwork. In some ways, that's the preferred way to execute buybacks because it takes the valuation assessment out of management's hands in much the same way as a monthly investment contribution plan does for individual investors. However, more often than not, companies continue to believe that they are best able to value their company's shares. And more often than not, they fail to do so. That's a big deal when you consider that S&P 500 companies have repurchased more than $5.3 trillion of their stock since 2010, according to the Wall Street Journal. In Q3 2021, share repurchases hit $234 billion, topping the previous record of $223 billion in Q4 2018. In December, the Securities and Exchange Commission issued a press release stating that it had proposed amendments to share repurchases disclosure rules. Share buybacks have become a significant component of how public issuers return capital to shareholders, said SEC Chair Gary Gensler. I think we can lessen the information asymmetries between issuers and investors through enhanced timeliness and granularity of disclosures that today's proposal would provide. The amendments would require a company to file a Form SR on the first business day after a buyback, disclosing the details of the purchases, including the number of shares purchased, the price paid per share, and the class of shares repurchased. In addition, and probably more important, the company would periodically have to disclose why it bought the shares and the criteria used to determine how much to repurchase. A January commentary from the D&O Diary published a guest post from Sarah Abrams, head of professional liability at Bowhead Specialty Underwriters, and Brett Hilgert, head of commercial D&O, directors and officers, at Bowhead Specialty Underwriters. Another pitfall to be mindful of in light of the SEC's recent focus on insider trading and related disclosures is that the company is the ultimate insider and, therefore, concerns about purchasing shares while in possession of material non-public information are magnified, Abrams and Hilgert stated. As the share repurchases get bigger, the odds of litigation arising over share repurchase programs and the breach of fiduciary duty by the board rises in lockstep. If Amazon's not careful, it could find itself in one or more lawsuits over the suitability of said share repurchases. In addition, the SEC's changes will make it more challenging to pursue buybacks willy-nilly. How much should Jassy pay for Amazon stock? According to PG60 of its 2021 10K, the company bought back $1.3 billion of its stock in the first month through February 2. Then, from February 3 through March 9, it bought back another $820 million. In those 68 days, AMZN stock traded between a high of $3,408.09 and a low of $2,720.29. Most companies buy right in the middle between the high and the low. That's about $3,064. Based on $2.12 billion, I estimate it bought back approximately 622,049 shares or 0.01% of its share count. To make a real dent in its share count, it needs to repurchase 10% of its 508.8 million shares outstanding. At current prices, that would cost Amazon $149 billion. In 2021, it used $9.1 billion free cash flow, $40 billion more than in 2020. That was due to a $20 billion increase in capital expenditures for COVID. In 2020, it set a record generating levered free cash flow of $36.5 billion, double the amount in 2019. Even with 2020 free cash flow, it would fail to come close to cutting its share count by 10%. So, the company is executing these share repurchases to keep issuing lots of stock-based compensation to employees, not to return capital to its shareholders. Warren Buffett has a generally good idea of how much he's willing to pay for Berkshire Hathaway, Break.B, stock. If there's anyone I'd trust to understand the intrinsic value, it would be the nonagenarian. My guess is that Amazon will generate an excellent long-term return on investment by buying its shares under $3,000, $150 post-split. We'll see if it has the discipline necessary to carry out a rational plan that makes sense for both the company and the SEC. More often than not, share repurchase plans don't deliver nearly the impact they're supposed to. So beyond covering stock issued for compensation, I don't think a share repurchase plan makes much sense for Amazon.